In this stock, I lost around 6.5 to 7%. So let me explain what happened here. So first, let us look at why I bought this stock. The same usual reasons. The yellow line is my buy price. This is the day I bought. So 16th of July. The blue line is my mental stop loss, which I will explain to you shortly. And the red line is my stop loss, which is the 8% level below the yellow line, below my buy price. So first, let us look at the base. I bought the stock when I was looking at this base. So let's draw the moving averages. So the 50-day, the 150-day, the 200-day, all three moving averages are moving up. The price is above these moving averages. So we have the blue, green, red combination, which is a good sign. It's a stage 2 uptrending stock. That is one reason I bought the stock. Second reason, look at this base. There are 4 points in the base, 2 contractions in the base. So this is 0.1, this is 0.2, this is 0.3, and this is 0.4. So 2 contractions in the base, 4 points in the base, and 10 candles in the base. 10 candles means 2 weeks of consolidation. Base means consolidation. Plus you see this huge rising window on high volume. That's a good sign. The stock has shot up significantly, and after that it started consolidating, forming a base, and it formed 4 points inside the base. Sorry, yeah, it formed 4 points inside the base, and I put my buy order at point number 3. Okay, and that is how I identified the trade. And I said, okay, let me get into this. You see this mother baby candle, the entire range of this candle is inside the range of this prior candle. The range means the distance between high and the low. So this is called as mother baby candle combination. It is a very powerful candle combination. In the West, they call it the inside bar. So after the inside bar, there is a potential that the stock will break out on either side, on the upside or downside. We don't know where. So I put a buy order, automatic GTT buy order, good till triggered, 2.5% position size. And let's see what happens next. See, it goes up and it comes down, closes below the yellow line. So there is huge supply on that day, huge demand as well as huge supply, but the supply overwhelmed the demand and the stock closed below the yellow line. Although it closed above the prior close, it is 2.51% up, but it has closed below the yellow line. That's a red flag. Okay, I should have sold half of my shares, but I did not do that. Okay, because I had unrealized gains in my account, I had realized gains in my account, so I could give the stock more time to run. Okay, now what is this blue line? You understood this yellow line. Yellow line is my buy price, red line is my 8% stop loss. So this red line is 92% of this value, the yellow line. Now, as we discussed, there are 4 points in the base. So 0.1, 0.2, 0.3, and 0.4. So point number 4 becomes my blue line, which is my mental stop loss. So I am saying to myself, okay, there are four points in the base. There are 2 contractions in the base. If the price closes below the blue line, I will exit the stock. I will not wait for the price to go all the way down to my red line, which is the 8% stop loss. And I also decided to give it more time because you see this base, the height of this base. See, it is roughly 10%. So it's a high quality A grade base. Anything from 0 to 10% means the stock has not given up too much of its gain. Okay, so here you see the stock makes 13%. From here to here, the stock makes, see, from here to here, the stock makes 30%. So the stock has shot up 30% in a few days, maybe a couple of weeks. Out of that 30%, it doesn't give up much. It only gives away 10% and keeps consolidating in a very tight range. So if I draw the bar chart, now you realize how the stock is consolidating in this tight box range. Okay, that was very encouraging to me. Only thing negative about this is that this was a high volume weak closing candle. High volume weak closing means on very high volume the stock closes below the midpoint of that candle. So the midpoint is high plus low divided by 2. So the closing is below the midpoint of the candle. If you look at the bar chart, see, now you understand the the range above the closing is more than the range below the closing. That's a negative sign. So that's what happened on the breakout day. I my position got filled in. 2.5% of my position got invested in this stock, and I gave it one more day. Then look what happened. The next day it came down, but it came down on low volume. See, the average volume is 1.97 million. The actual volume is 1.99 million. So it is slightly above average, but I would say it is average volume. So if the stock is coming down like 2.5% on average volume, shouldn't be much reason for a concern, right? Because if it had come down on a huge volume, that would indicate institutional selling. But here, I don't see any institutional selling because it's average volume. Maybe retail guys are getting out, booking some profits here. But these two candles should have given me a hint to at least cut half of my position. But I did not do that because I had unrealized gains. There were other stocks in my portfolio on this day which were making money. So why should I sell this? Okay. However, if there were no stocks in my portfolio which were having gain, and this was the only stock, or maybe this was one stock and there were two other stocks which were simultaneously coming down, then probably I would have sold half. Okay. So the selling decision, most people think that the selling decision is based on the chart itself. Whatever the chart tells you, you do it. No, I disagree with that. The selling decision is also dependent on where else your money is invested and how are those assets doing overall. So how is your overall portfolio doing? If your overall portfolio is bleeding, you need to start cutting positions. Otherwise, your losses will expand. Now here I had no reason to sell because the chart was indicating to me that the institutions are not selling. Look what happens next. It breaks my blue line. Okay. The moment it breaks the blue line, I said, that's it. I don't care whether it's low volume, high volume. I expected the stock to at least remain above this blue line. Okay. And I decided, okay, I'm done with this stock. I would probably exit because I don't want to book that additional loss here. So if I see from the yellow line till here, that's 6.97% loss. So roughly 7% loss. So I saved 1%. Okay. Just because I was drawing the blue line, I saved 1% extra that I could have lost in this stock. Okay. So that is how I handled this trade. Sometimes when the price comes out of a tight range, does not necessarily mean that the stock will go up. Okay. Sometimes it comes down as well. It is very important to study breakouts and fakeouts. One hint that this stock gave me, which I ignored, is this. See, if I draw the base, see above this dotted red line, okay, there is hardly any price action above this dotted red line. After a point two, see, one, two, only two candles have closed above this. If we ignore this breakout candle, only two candles have closed above this dotted red line. Okay, that is not what we expect. We expect good consolidation in the upper half of the base. And if we look at the upper quarter, okay, the upper quarter was there is absolutely no price action. Not a single candle has closed before this breakout candle. Not a single candle in the base has closed in the upper quarter. That's another negative sign. So these are two things which I should have noticed. But since there are other stocks in my portfolio, I was not concentrating here on this base properly. So my argument is the base, if you can study the base properly, and if you can write some notes here, okay, so you can go here and you can write some notes here. You can write, say, be cautious. Then you can say no price action in upper quarter. Then you can write minimal closings in upper half. Then you can write play for a shorter move. Then you can write this is a base is A grade. Okay. If you write these points, then every time you come and look at this chart, you don't have to analyze the base. You just read your notes and then take a decision on a candle by candle basis. The moment I write be cautious here. Now these notes could be written before this day starts. Okay. So on this day, when it closed below the yellow line, these notes would have easily given me a hint that I need to cut at least half the position. Then after this candle came, so there was no follow through. At least the next candle should have closed above the yellow line. There was no follow through. So again, on this day, I should have sold another half of my position, but I did not do that. I could have minimized my losses. Instead of booking 6.97, I could have easily came out with like 2 to 3% overall loss on this 2.5% position size, right? So it's important to study the base before the breakout, write down some notes here, and then play the stock accordingly. So I hope you understand my thinking process. Why did I buy the stock? Why did I held on to the stock? In what scenarios I would have held on to the stock, and in what scenarios I would have exited the stock? The importance of writing notes on your charts, the importance of placing a mental stop loss, which is the blue line on your chart, the importance of placing the hard stop, which is the red line on your chart, the importance of looking at the upper quarter and the upper half and the price action in these areas. All of these things I have discussed in a single chart, in a single base. So probably watch this video once or twice more so that you get a better understanding when you are trading such bases. Even if it's a grade base, ultimately it resulted in a loss, right? So a clean and simple base does not always work. Okay. You have to understand that there are breakouts and there are fake outs. You have to understand when to stay with the stock, when to get out. Okay. So this stock has eaten into my unrealized gains, not my realized gains, but I could have minimized the damage here. Okay. So if you have any questions, let me know in the comment section. Thank you so much.